Welcome. This is Tax Pro Nation, the home of the independent tax professionals, where you can find a tax community, maximize your earnings, and live life on your own terms. I'm your host, Imelda Ledesma, COO of Pronto Tax School. We are back with Season 5, covering Schedule E. In this episode, Andy and Daren will dive into the trends of Schedule E, self-rental rules. They will cover entity bonus, strategies, and pitfalls.
So we were going to talk, you guys, once Daren jumps on, about the self-rental concept when a client has a business entity, and I think that it's something that has gotten a lot of publicity in the past couple of years, around, as part of the overall tax planning. Whether you want to call it like a frenzy or a trend or whatever it might be, this, more and more talk of tax planning techniques, the self-rental, the Augusta rule concept, for especially, I think, for S corporation shareholders, smaller S corporations, is kind of that one of the popular techniques that that we're told that we should know and feel familiar and be familiar with and be doing for our clients, right? So what we found, though, is that and not only just in the tax school network, but in our own businesses of doing this kind of work, is, hey, Daren, we may not have this. Not all of us have like a really clear idea of when it's okay to do this strategy, when it's not, how to actually do it, and that kind of thing. So, with that being said, we have our guest of honor here, Daren. I was just talking, Daren, about how like the self-rental and the whole Augusta rule thing, it seems like it's something that everybody talks about, but maybe we don't feel as confident to actually implement. Would you agree with that, generally speaking? I can't hear you, though.
There we go. Can you hear me now?
Yeah, your mouth was moving, but there was
Yeah, there we go. Yeah, it's that little guy. Sorry, getting back to it. 10 days out of the office, and 7 of them without cell service. So it was nice. I was up in the 20 miles deep in a canyon in the High Sierras. So
wow, cool.
Yeah, it was nice. So anyways, walked back in this morning from being out from 10 days. So sorry, I can't even get my headset right. So getting it back together. But highly recommend to everybody, if you need a break, take one. It's good for the soul. Got to be a dad for a week, so it was
awesome, man.
With no work, good family time. So self-rental rule, the Augusta rule. The internet loves to play that one up. That like if your accountant isn't doing that for you, then I love the new one. Is your CPA or is your EA working for you or working for the IRS? That's the big label that's like on top of every post. And like, if you're not doing the Augusta rule, then your accountant's working for the IRS and not taking advantage. But it's a lot harder to implement, and it's not as easy as the internet says to pull it off, because you actually have to do something. You just don't get to rent your house to your company for a week for $1,000 a day. Or $3,000 a day, or I've seen all types of levels of it. Accountants that completely and utterly take advantage of it, and do like a $30,000 payment for a week to rent the house out for a company retreat. And it's like, come on, you can't do that. And so, is it a red flag? I mean, if you're already in an audit, probably, yeah. You don't even put it on the return, so how much of a red flag can it be? So it depends on how high the rent already is on the entity return, is where the red flag comes in. Really, it boils down to did something really happen or not? Like, did you actually have an event? Things of that nature. And then from there, you actually got to go online and find out like what's an event-based rental, because the trouble you run into on it too is, things they disallow in audit, like flying private. Like if it's $5,000 for a private flight and you didn't actually need to get there that fast, they'll probably discount that down to a normal coach ticket, from $5,000 down to $300. So if you got to look at fair rental rates, what would an extra what would a different space have cost, things of that nature. So you got to keep it within fair market value, everything else.
So just to kind of, for the sake of this conversation, I think, and let me know, you guys chime in here if you think this is a good way for us to take this, is like, let's say, I've done some of these myself, or, but again, we're just not 100% sure of like what the step-by-step process should look like, right? So I feel like, I want to, because when you say things had to really have happened, right? Some of these things could happen in the future year. And so you're making like a suggestion that something would happen. Or maybe you're like, it's like the whole thing about remembering something different in the past that had happened, and now it's fitting into this little, so there's like, it seems like there's a little bit of gray area there. So like, just in terms of the first step of, I want to reduce my clients' taxes as much as possible, by anything that's legal and ethical. This looks at like an appealing loophole that I'm seeing on the internet or heard from a different seminar or webinar or whatever it might be. What do I do to assess, Daren, or how would you assess whether it's actually a legitimate use, and like what kind of uses would it be, that kind of thing? And let's imagine, I think, because it seems like it's mostly S corporation shareholders, I would say, that
Correct.
are utilizing this. So kind of what's the eligibility aspect of it?
So the eligibility aspect of it is, and let's look at it. So what the Augusta rule is just if you rent real estate out, your own real estate, for less than 7 days, you don't have to claim the income, is what it boils down to. Or is it less than 14?
14.
14. Yep. Less than 14. So, where it comes in usually, so the ones where I use it for my clients legitimately outside of the entities is like, I have one client that is president of the Homeowners Association. She has an annual event there for the flowers every year. Costs her like $5,000 to do it, but they pay her to reimburse that. So, or like site fees when you rent your house out or driveway out or something like that to production companies. They might be filming for a day, things of that nature. Where the rule came from, they call it the Augusta rule because of the golf courses, because it just didn't seem fair. People would rent their house out for like 2 days for these big golf tournaments, for like $1,000 or $5,000 a night. So where this is bled into is people suggest for entities to rent their personal real estate rent it to the corporation for this less than 14 days. You write it off as rent from the company, and then the shareholder doesn't have to claim it as income. So the situations where I see it, or clients that I bring it up to, are, one, is it a client-based business? So for your client, is what type of business are they in? Are they a service-based business? Are they a client-based business? Or are they, retail or online sales? So this rule really comes more towards clients, like client-based businesses, people-based businesses. Do they have employees? Is there a bigger staff? Things of that nature. There has to be something within their business that would even create the opportunity to have an event. So that's how you kind of need to first filter who you would even bring this up to. And, are they a local company, nationwide company? Is it all online? Do they have physical presence? Things of that nature. And then, so if they make that first filter and be like, okay, they could actually have an event at their house, then yes, the company could rent the house, from the individual to have an event. But even on that one, you're only talking 1 day. So, as far as on these, internet schemes and things of that nature, most of the stuff that they put on there, you can't even get more than 1 or 2 days of rental. So what are we really talking about here? So that's the big difference, is like, yes, you could do it for 13 days, but there's no real plausible situation where you would. And so if they make it through the first filter, and they could at least have an event, but you're also talking over the span of the whole year. So if they could have like a quarterly event at their house, or if they're realtors. For them, though, if they're having, like client appreciation things at their house once a month, then you can get, 12 events out of it. So that's where you could get, multiple events on it. And then you got to look at the market rate of what it would cost to rent, similar size or space to have an event. So you got to, have some type of justification for the, event, the space fee that you're actually paying for. And so once you get that determination, probably between 800 to 1,500 bucks, maybe. So depending on the client and everything else, and that's where from these things is how much time are you going to put in, to get $1,000 deduction, not too much if they can only do an annual, but if it's some type of business where you could do something monthly, then you can get up to 12. So then you're talking, maybe $10,000 to $20,000 write-off over the course of the year. But you got to filter it down to the clients you would even bring it up for. And for me, that's more the ones I bring it up to are the service-based, client-based, real estate agents, financial planners, things of that nature, consultants.
And team-based, like even if someone has vendors or they bring people together, they bring teammates together for a retreat or something like that. So
for a retreat, yeah, and then that would be and then the additional level would be is if they have employees, then you could have a company meeting that company retreat that night, or maybe a day or two. I did have a client that he had which I busted him on anyway because and this is where too is they actually have to do it. So I had a client that had a cabin up. We did the books for the company, but there was a different CPA that did the tax return. And he was reclassifying distributions as rent twice a year for the company retreat. And one of them was on a day that I was at the office and everybody was there. They were doing these 3-day retreats up in Big Bear and renting it out at like $2,000 a night for his cabin. And, I had to sit them down and say, hey, everybody was in the office. Everybody has emails going out, everything else. Like, there's no way you could prove that this event even happened or anybody went. And then if you've got an auditor, ask your employees if they went or if this event even are you going to ask your employees to lie for you because you're getting audited? And so that's where you need to bring up to your client that, these things really need to happen because you can't expect anybody to lie on your behalf, things of that nature. And so, yeah, they were saying there's company retreats 2-3 times a year and renting his cabin out, which is a great idea. If you invite your staff up to your cabin for a company retreat, and then rent it back to yourself, sure. But everybody's got to actually go.
So eligibility wise, then we're looking for legitimate business use. And typically it's going to involve other people or hosting some kind of an event, either clients, customers, or team members, or some combination, right? And then you have to actually do it, not just imagine that you could have done it. And then you mentioned that we also would need to, either we or the client, but I guess the client would take the final responsibility, needs to establish some kind of a reasonable value for the rental.
Correct. And then you want to have backup.
And then it has to be value. And then it can't be more than 14 days throughout the entire year. Correct. So that sounds like the initial sort of eligibility of whether someone's looking at actually doing this, and those are the boxes that we need to check, right?
Correct.
Okay. So let's say that happens, right? Let's say you check all those boxes. At this rate, it might even be a client, right, Daren, that they heard about this on the internet and they went and did it during the year and they were, or tried to do it, and now they're bringing it into us to kind of get it administered, right? So in terms of administering it, so at that point, I'm going to enter a rental expense on the company tax return, and correct. And on the personal tax return, am I going to issue a 1099? Am I going to report that anywhere on the personal tax return? What do I do on the personal return?
On the Augusta rule, I don't report it on a lot of them. A lot of the times, you can put it on as rental income, and then deduct it as an expense, and then cite the IRC code on it in a note.
And is it acceptable to, because, my policy, if I don't have to do something, then I try to not do it. So it's kind of like a little either or type of scenario. So what if I just don't put it on the 1040 at all? Is that
at all? Then
am I a bad person?
I don't think you're a bad person if you don't put it on at all. There's not any requirement that says that you have to put it on and take it back off.
I thought that was the whole appeal to it, is that you don't have to report.
Correct.
For that.
Yeah.
I mean, you would report the expense on the.
Yeah, the only time that I've ever reported it is when it's through a third party, like from a movie production company or something like that, and there's a 1099.
Gotcha. Or you're just trying to address the 1099 reporting and make sure it's not
correct. I don't 1099 the owner of the company, because then that just as far as the red flag goes. I mean, you don't want a W-2, a 1099, and a W-2, a 1099, and a K-1 going out to the same social security number.
Yeah. Okay. And then so I can see why this has become popular, right? Because it's like you're getting a write-off. You don't have to bring anything into your personal return, and you're making a non-deductible expense that you already had for something that you presumably enjoy, your own real estate, right? And you're now getting a tax write-off for some portion of it. So I can see why, and you don't have like a lot of administrative hassle or something like that. Do you feel like there should be some kind of like written lease or terms of service?
There should be an agreement, like some short-term rental agreement, something even one page, like this company's renting this place for the night or for the day, and what the event's for, and the price. And then that's the other thing too, is I don't like reclassifying distributions for these types of things, because that just doesn't hold water at all. I mean, you want to have an actual either check written from the company to the owner, or a specific transfer with a memo on the transfer that it's for this, for event space.
Yeah. And so speaking of reclassifying distribution, so we I think have talked about this a few different times, where the owner, a lot of times with these smaller companies especially, right, is just kind of drawing out money, as they can and need. And then after the fact, you may have some things that you could reclassify, like vehicle expense, or where they had business use, but they weren't being reimbursed by the company. Is that something very commonly that we do during tax preparation, is look at those kinds of things, right? And so with this, the idea of, okay, you did have business use of your home, let's say it is, that meets this definition. Maybe you didn't even know or were planning that there's this, but to me, it sounds like that. Are there any circumstances where I would continue to not be a bad person, and then I would reclassify some of those distributions?
Yeah, it would have to really line up, though, because you couldn't really just, you would have to see, well, and that's where too, though, is and what I like to do for my clients is turning things that are not deductible into things that are deductible by doing it correctly. Right. And so if you get into the conversation, let's say, as you said before, like, let's say the client brings it up to you, and they're like, hey, I saw this thing on the internet, the Augusta rule, why am I not doing this? And so that's where my first question to the client would be is, well, did you do anything that would constitute the company renting the house from you? If they're like, well, yeah, I had, everybody over for this big, huge dinner party. And so then you would go back and look and say like, oh, okay, well, you should have rented it from it. You could go back and look. And I would say timeliness is an issue, to see if there was a distribution around the time of the event. Right. And then I wouldn't just cherry pick it and do a year-end journal entry against it. I would make sure that there was some type of journal entry or some type of distribution around then. So everything for an after the fact, it would all kind of have to line up so that it looks timely. And say like, oh, okay, on this one they did a $5,000 private distribution, and an extra $1,000 was to rent the place for the night if it was around the time of that one. And so I would say if it all lined up, you could.
Okay. And so if you, let's say you had like 10 days of business use and you were able to legitimately assign like, let's say it's $1,000 a night for the self-rental home usage, you would think as a tax preparer that, well, I need to still make some kind of like consideration of my personal use during that time. It almost starts to fall into that too good to be true type of territory, right? Because I don't need to make, it's almost like during those 10 days, Daren, I didn't make use of my personal home for my personal home, right? I just writing off like the entire thing as even more than the entire, I'm not like I'm just writing off my mortgage. I'm actually writing off like, it seems too good to be true in a certain way.
Yeah. I mean, it does. And that's why you got to cross all the T's and dot all the I's. And you can't just haphazardly do it because it does seem too easy to do.
Okay.
But
So
there's all these little things in it that under audit, it's not going to pass muster.
Yeah. Okay. So the kind of the price I pay for it being too good to be true and reducing my taxes by, let's say I have a $10,000 deduction. I'm at a 40% tax rate. I just saved $4,000.
Yeah.
The price I pay for that is having to do it correctly, make sure it's defensible. And on that same note, Steve had a question that dropped in the chat. And this is a common concern that I hear a lot about is can you get in trouble for not issuing a 1099 to yourself? Or would you recommend they pay with a credit card, which I guess would even generate now potentially a 1099K?
Yeah, well, you couldn't really run a credit card because the owner would have to have merchant services set up under their own name. So you couldn't really do it through a credit card.
Thank you for joining us. I'm Imelda. Join us next week as we continue to share mini audio clips of Schedule E tax prep process. If you are interested in listening to the full process and want to be part of our Dream Team community, please visit prontotaxschool.com or email us to support@prontotaxschool.com. Being part of the Dream Team membership comes with getting expert support, top-rated training programs, and weekly video live events. We look forward to having you on board.